Every country on Earth owes money. The United States owes over $38 trillion. The European Union owes around $14 trillion. Japan owes nearly $9 trillion. Even nations with oil wealth, gold reserves, and industrial power are deep in the red. But here is the paradox. If every country is in debt, who is the lender? Who do nations owe money to? Who holds the ledger? Who receives the interest? Who benefits from a system that never seems to shrink, only expand? And perhaps the most unsettling question of all, is it even possible for the world to be out of debt? Or is the system designed to ensure it never happens? To answer this, we need to understand how debt became the foundation of our global economy. Today, governments finance themselves through something called sovereign debt. This is the money nations borrow to pay for military programs, healthcare systems, infrastructure projects, education, social benefits, and sometimes political promises meant to win public support. But historically, it wasn't like this. For most of human civilization, governments funded themselves through taxes, trade, land, and direct control over resources. Debt existed, but it was temporary and often viewed as dangerous, shameful, or morally questionable. Things changed with the rise of central banking and the professionalization of finance. The first modern central bank, the Bank of England, was created in 1694. Its purpose was to lend money to the government to fund war. Instead of raising taxes, which was politically unpopular, the government simply borrowed and promised to repay later with interest. This model spread across Europe and eventually the entire world. It allowed governments to spend more than they actually possessed, which made debt not just useful, but powerful. Fast forward to the 20th century. For a long time, currencies were backed by gold. That meant every dollar represented a real physical asset held in reserve. This system limited how much money governments could create because there is only so much gold in the world. But world wars, expanding populations, industrial growth, and rising social expectations demanded more spending than gold reserves could support. The system began to break under pressure. On August 15, 1971, U.S. President Richard Nixon ended the convertibility of the dollar into gold. Without gold backing it, money was no longer tied to physical resources. It was now tied to trust and to the government's ability to tax its citizens in the future. This system is known as fiat currency. Money has value because the government says it does. But fiat currency has a consequence. When new money is created, new debt is created along with it. Debt becomes permanent. Nations borrow continuously, interest accumulates endlessly, and national debt grows forever. Here's how governments borrow money today. They issue bonds. Investors buy these bonds. Governments receive money now, and investors are paid back later with interest. But who are these investors? It's not just other countries. In fact, that's only one layer. Domestic banks, pension funds, and insurance companies buy government bonds. Private global investors like hedge funds and wealth management firms buy them in huge volumes. Central banks, like the Federal Reserve, the European Central Bank, and the Bank of Japan, literally create money and use it to buy government bonds. And beyond all of this is the vast abstract financial market, a network of institutions, funds, trading algorithms, and investment vehicles. This means that the creditor is not a person. It is not a government. It is not even a single corporation. The creditor is a system, a network, a financial architecture that spans the globe. Debt does not simply exist, it grows. Governments rarely pay back what they borrow. Instead, they borrow more money to pay off previous loans. This is known as rolling debt. Debt is not meant to be paid back. It is meant to be serviced. Governments pay interest forever. And because lending creates money, the money supply depends on continuous borrowing. If governments stopped borrowing, the money supply would contract. Economies would slow. Unemployment would rise. Markets would collapse. Debt is not a flaw of the system. Debt is the engine of the system. The more a government borrows, the more power creditors have. This is how institutions like the International Monetary Fund and the World Bank became some of the most influential forces on the planet. When nations cannot repay debt, they are forced to cut public services, sell national resources, privatize state industries, and open their economies to foreign corporate control. Debt becomes a tool of influence, a form of global leverage. Throughout modern history, we have faced repeated financial crises: the Great Depression, the Latin American debt crisis, the Asian financial crisis, the global financial crisis of 2008, the economic shock waves of the pandemic. Each time, governments lower interest rates, borrow more money, and central banks create more currency. Every solution expands the system further. Every rescue creates more debt. Today, global debt exceeds $307 trillion, more than 3 times the value of all goods and services produced on Earth in a year, more than the combined value of all land, buildings, businesses, and assets on the planet. Debt has surpassed production. It has surpassed resources. It has surpassed reality. The world is not in debt to someone else. The world is in debt to the system itself. The creditor is the global financial network, the architecture of central banking, the mechanism of fiat currency, the expectation of infinite growth. Debt is the product. Debt is the fuel. Debt is the structure. Here are 3 things to understand. First, debt is not a mistake. It is the foundation of modern economies. Second, the creditor is not a single person or country, but a distributed financial system. Third, the debt cannot be fully repaid. If it were, the global economy would collapse. As global debt continues to rise, the system becomes more fragile, more interconnected, more dependent on confidence, and more vulnerable to shock. If trust fails, the system will not decline slowly, it will break suddenly. The real question is not whether the debt system will change. The real question is what will replace it when it does. If you found this explanation valuable, share this video. And if you want more deep, fact-based investigations into how the world really works, subscribe. There is much more to uncover.